On November 4, 2000, the board of directors of Pets.com voted unanimously to liquidate the company, to dissolve it, to sell everything. The day the shutdown was made public, according to her own account, the CEO's husband asked her for a divorce. Within hours, Wainwright lost her company. What was left of the company would be auctioned off, inventory, brand, and a sock puppet that had become known on television. That floppy-eared dog with a patch over one eye had come to be worth more than many real businesses. Months earlier, the market valued Pets.com at around $264 million. Shortly after, it was worth nothing. How was that fortune incinerated in less than a year? The answer lies in a simple bit of arithmetic that nobody wanted to see. To understand it, we have to go back to a moment when it seemed like the rules of the economy had changed. Between 1990 and 1997, the percentage of American households with a computer went from 15 to 35%. The internet stopped being a laboratory curiosity and became a living room appliance. The NASDAQ Composite Index rose 600% between 1995 and its peak on March 10, 2000. 600% in 5 years. Companies didn't need profits. They needed a story, a web domain, and a promise. It was a collective faith, and like all faith, it shielded believers against arithmetic. In that climate, in February 1999, Pets.com was born. The idea was simple: sell pet products over the internet. The problem was in the arithmetic. Shipping a 20-pound bag cost money, and the margins couldn't cover the transportation. That was the question very few people asked. How much is lost on each order delivered? Julie Wainwright arrived when Pets.com had just 2 people and an idea. She wasn't the founder, but she was the one who led it through its meteoric rise and its IPO. Behind it were heavyweight investors. Before the public offering, Amazon owned 40.7% of Pets.com. Hummer Winblad, 21.2%. The founder, George McLemore, 6.8%. Bowman Capital, 6.3%. What did Amazon see? A company that did understand e-commerce? That question alone was enough for Wall Street to trust. The IPO would dilute them. Amazon would drop to 30.4%, Hummer Winblad to 15.8%, McLemore to 5.1%, Bowman to 4.7%. Confidence remained intact. The bet seemed sensible. The financial statements told a different story. In the last quarter of 1999, Pets.com sold $5.2 million worth. The products it sold costed $11.6 million. Every sale was a structural loss, not a passing stumble. On top of that, marketing and sales spending tripled in the final countdown to the IPO, from $10.7 million to $30.7 million. To sell $5.2 million, they spent $30.7 just on getting themselves known. The quarter closed with a loss of $42.4 million. From its founding through December, Pets.com lost $61.8 million on sales of $5.8. In the full year total, the goods sold cost $7.62 million more than the revenue. For that campaign, they hired a secret weapon, a sock puppet. That floppy-eared dog with a patch over one eye became a phenomenon. It appeared in TV commercials. It had charisma. It had recognition. It even had its own merchandise. What it didn't have was a business model to sustain it. The puppet was more famous than the company that had created it. And in the new economy, that was mistaken for success. Executives saw reach, not profitability. Investors saw a recognized brand. Very few asked the uncomfortable question. The answer was in the documents, and it wasn't pleasant. In early 2000, Pets.com was preparing its IPO. In its filing with the SEC, dated January 21st, it estimated offering 7.5 million common shares at a price between $9 and $11. Expected net revenue came in at around $68.8 million, nearly $11 million less than initially calculated. With 26.4 million shares outstanding and an average price of $10, the initial market value was estimated at around $264 million. $264 million. For a company losing more than 10 times what it was selling. The narrative had replaced the balance sheet. The question wasn't whether it would go bankrupt, It was when the outside money would stop coming in. The market chose to answer soon. On March 10th of the year 2000, the Nasdaq Composite reached its peak. It was the top of the bubble. From that point on, cheap money stopped flowing. Investors began looking at balance sheets. Webvan fell, so did Boo.com, North Point Communications, and Global Crossing. WorldCom ended up renamed MCI in 2003 and bought by Verizon in 2006. Even Amazon and Cisco bled. Cisco lost 80% of its stock value. The Nasdaq Composite fell 78% from its peak to October 2002. Pets.com depended on continuous funding. Its clock ran out at the exact moment capital stopped financing losses. On November 4th of the year 2000, the board of directors unanimously adopted a plan of complete liquidation and dissolution. It wasn't a restructuring, it was the orderly exit of a corporate corpse. The public announcement came on November 8th. Out of 320 employees, 255 were laid off immediately. The company would sell most of its assets, the remaining inventory, and the intellectual property of the sock puppet. The dog that had starred in the commercials became just another asset in the liquidation. Julie Wainwright, the chief executive, was the one who had to turn off the lights. She hadn't been the founder, but she had been there from the start. Years later, she would recall it with a devastating phrase: "It failed, and I became sort of a pariah. I was the dumbest person in the valley. It failed." And she became, in her own words, the dumbest person in the valley. The dissolution followed its legal course. On January 16, 2001, the shareholders approved the plan and the name changed to IPET Holdings. The certificate of dissolution took effect on January 18th. That day, the transfer books were closed and the common stock was delisted from the Nasdaq. Pets.com, as a publicly traded entity, ceased to exist. What had begun with a simple idea and Amazon's backing ended in an administrative proceeding. The sock puppet, the most visible asset, was sold as intellectual property. No one ever saw it on television again. Its image remained forever tied to the excess of an era. Julie Wainwright's story didn't end there. In March 2011, she launched The Real Real, an online marketplace for secondhand luxury goods. In June of that year, they began shipping the first orders. In its first year, the platform recorded $10 million in sales. These weren't projections, they were revenues from products delivered. By July 2017, The Real Real had raised $173 million from 22 investors. The lesson was clear. It wasn't about avoiding risk, it was about building a business that could breathe without artificial oxygen. Wainwright had been labeled a failure, but failure, well managed, can be the best accelerator. In the end, the sock puppet wasn't the owner of the fortune. It was the witness of its evaporation. It watched an idea burn, the idea that a brilliant brand could replace a balance sheet. It watched an era burn, an era when growth was measured in promises, not margins. And it saw something the market never forgets. Capital is patient, but it isn't naive. It forgives the mistake, it doesn't forgive the math. Pets.com closed. The Nasdaq took years to recover its peak. But the woman who turned off the lights learned the lesson, and she turned them back on. The puppet disappeared. The executive rose again. And the question still lingers: how much is a promise really worth?